Bitcoin's recent price action has displayed a significant upward rally. This rally was subsequently followed by a notable pullback in its value. This indicates a struggle for the cryptocurrency to maintain its upward momentum. Such a pattern is frequently observed in highly volatile asset classes. It typically emerges after periods characterized by rapid price appreciation. This behavior reflects the inherent market dynamics of speculative assets. Price charts illustrate market movements over time, revealing patterns and trends. Resistance levels are specific price points where an upward trend is expected to pause or reverse. These levels often correspond to historical highs or significant trading volumes. They act as barriers, indicating strong selling interest that prevents further price increases. Traders and investors closely monitor these thresholds for strategic decision-making. Daily candlestick charts provide visual insights into market price movements. A sequence of red candles following green ones indicates a shift in market sentiment. This pattern confirms increasing downward pressure on the asset's price. It signals the initiation of a price correction phase. A common market reversal indicator. A market analysis often involves observing trading volume in conjunction with price movements. An increase in trading volume during a price decline signals a surge in selling activity. This heightened volume validates the strength and conviction behind the price pullback. High volume on downward price movements indicates strong conviction among sellers. The order book is a crucial tool for market analysis, displaying real-time buy and sell orders. It often reveals concentrations of sell orders at specific higher price points. These concentrations form what are known as resistance walls in the market. Resistance walls indicate significant selling pressure, preventing prices from easily rising further. Such order clusters reflect collective market sentiment and potential price barriers. Profit-taking is a market action where investors sell assets. This occurs after a significant price increase to realize accumulated gain. The act of selling introduces increased supply into the market. This increased supply creates selling pressure on the asset's price. Consequently, this pressure can lead to a price pullback or correction. After a significant market rally, many short-term traders begin to close their positions. Early investors also choose to cash out their accumulated profits at this stage. This collective action of selling leads to a substantial increase in supply within the market. The increased selling pressure contributes directly to the observed market correction. The market mechanism for Bitcoin, like other assets, is governed by the principles of supply and demand. When investors decide to realize profits, they sell their Bitcoin holdings. This action leads to an increase in the available supply of Bitcoin on exchanges. If this increased supply is not met by a corresponding rise in demand from buyers, the resulting imbalance between excess supply and insufficient demand inevitably drives Bitcoin prices lower. Increased selling activity in a market can significantly impact its dynamics. This often leads to a temporary reduction in market liquidity. Liquidity refers to the ease with which an asset can be converted into cash without affecting its price. When liquidity decreases, it becomes harder for buyers to absorb large sell orders. Attempting to do so without causing significant price drops becomes challenging. This reduced liquidity amplifies downward price movements, exacerbating market declines. Psychological resistance levels are key concepts in market analysis, influenced by collective market participant behavior. These levels represent price points where selling pressure is expected to increase, hindering further price rises. Often, these resistance levels are round numbers, such as $70,000 or $75,000 for assets like Bitcoin. They can also be significant historical price points that previously acted as barriers or support. Such levels are perceived as barriers, influencing trading decisions and market dynamics. Market psychology explores how emotions and cognitive biases influence investor decisions. Investor sentiment reflects the overall mood and attitude of investors toward a particular asset or market. When assets like Bitcoin near psychological price thresholds, sentiment can shift rapidly. This shift often moves from bullish optimism to cautious apprehension, increasing selling pressure. The fear of missing out, FOMO, transforms into the fear of losing gains. Folg. Market psychology explores how human emotions and cognitive biases influence financial markets. These market levels are not determined by fundamental asset value. Instead, they stem from collective human cognitive biases. Past price actions and their memory also significantly shape these levels. This creates a self-fulfilling prophecy where belief in levels reinforces their existence. Market memory is a psychological phenomenon influencing trading decisions. It refers to traders recalling past price rejections at specific levels. These historical rejections reinforce the perception that certain price points are difficult to breach. This perception leads to the formation of psychological barriers in the market. Traders strategically place sell orders at or near these remembered resistance levels. This collective behavior creates a strong market memory effect, impacting future price movements. The relationship between cryptocurrency and interest rates is typically inverse. When interest rates rise, the appeal of riskier assets like cryptocurrency tends to diminish. Higher interest rates make traditional savings accounts and bonds more attractive. Investors may shift capital from volatile crypto to more stable, interest-bearing assets. Central banks worldwide are actively adjusting their monetary policies. A common strategy involves raising interest rates to combat inflationary pressures. This tightening of monetary conditions reduces overall liquidity in financial markets. Consequently, these policy changes significantly impact risk assets across the economy. Macroeconomic factors significantly influence investor behavior and market dynamics. One key factor is interest rates, which central banks adjust to manage economic conditions. Higher interest rates generally lead to a decrease in overall market risk appetite among investors. Investors become more conservative, prioritizing safer investment options over volatile assets. This shift reduces capital inflow into riskier markets, such as the cryptocurrency market. Consequently, higher interest rates often result in diminished investment in cryptocurrencies. Macroeconomic factors significantly influence capital flow across various asset classes. When investor risk appetite diminishes, capital tends to shift away from speculative assets. Funds are reallocated into more stable, yield-bearing instruments, seeking security. This shift includes a movement of capital out of highly volatile assets like cryptocurrencies. Such a reallocation of funds exerts downward pressure, leading to a decrease in crypto prices. Macroeconomic factors significantly influence investor behavior and market stability. Global economic uncertainties, such as geopolitical tensions, contribute to market volatility. Inflation concerns also play a crucial role in shaping investor sentiment. These factors collectively lead to reduced investor confidence in risk assets, fostering a cautious investment environment. In the short term, Bitcoin's price may find support at specific levels. These support levels often include previous consolidation zones. Key moving averages also act as temporary floors for the price. Traders closely monitor these technical indicators for potential price stability. Following a price pullback, Bitcoin may enter a reaccumulation phase. This period is characterized by the asset trading within a defined price range. During reaccumulation, buyers gradually absorb existing selling pressure. This absorption of supply indicates a strengthening of demand. The reaccumulation phase is a common precursor to the next significant price movement. It signifies a potential shift from bearish to bullish market sentiment. Ethereum's price action often correlates with Bitcoin, indicating similar market movements. This correlation suggests that Ethereum is likely to experience comparable price pullbacks. It also implies that Ethereum may encounter similar resistance levels in the market. Ethereum's price will be influenced by its internal ecosystem developments. Broader market sentiment will also play a significant role in shaping Ethereum's price. Ethereum's immediate price trajectory is influenced by key technical levels. These levels include indicators such as the 200 day moving average. Previous swing lows also serve as crucial technical support or resistance points. Maintaining above these levels suggests potential price stability or upward movement. Conversely, Breaking below these levels could signal further downside pressure for Ethereum. Both Bitcoin and Ethereum are anticipated to experience ongoing short-term volatility. This market behavior is driven by participants reacting to new economic data releases. Central bank announcements also significantly influence these market reactions. This inherent characteristic of volatility makes short-term predictions particularly challenging. The short-term trajectory of the crypto market is significantly influenced by external catalysts. These catalysts are events originating outside the intrinsic market dynamics. Regulatory news, such as new laws or government statements, can act as a major catalyst. Announcements of major institutional adoption also serve as powerful external catalysts. Significant technological upgrades within crypto networks can also trigger market shifts. These external events have the potential to induce rapid and substantial price changes in the market. A confluence of factors suggests a neutral to cautiously bearish short-term outlook for the crypto market. These factors include profit-taking, psychological resistance levels, and macroeconomic headwinds. Investors should anticipate continued market consolidation or further price correction. A sustained upward trend is unlikely to reestablish itself until these conditions subside.